Hey guys, so we're going to talk about our chapter 1 in our 11th edition Redbook. And so this chapter is kind of like an introduction to what's to come. And we talked a little bit about this in class, where we're going from that corporation merchandising business that just has a general sales and purchases to a departmental type of accounting where we're going to keep track of every single different type of item that we sell. So it could be paint, we could sell paint and lumber. And so we'll keep track of all of our paint sales individually, and we'll keep track of all of our lumber sales. So let's just go ahead and get going on this slide. So the first chapter is just a review. What's an asset? What's a liability? What's owner's equity? So, they talk about, that those departments and why we would want to have reporting for those different departments. And it really is just to see how much we're making in each of those and how much each section is costing us. So if we have them all lumped together, we could still have a good number of sales, but we don't really know how much each of our individual sections are costing us or how much we're making in each department. So for example, what we in retail we call these hard lines and soft lines. So our hard lines are the grocery store, the grocery part, um, the I don't know how to explain this. The furniture, all of the. It's easier to explain soft lines. So soft lines would be like clothes. Okay, the clothes would be soft lines. Everything else, clothes, jewelry, those would be soft lines. Everything else in the store would be considered hard lines. So your deodorant, your toothpaste, your toilet paper, your TVs, um, your sporting goods stuff, that's all hard lines. The clothing section, all the clothing, your jewelry, those would all be soft lines. So hopefully you kind of get an understanding. Just it's kind of hard to explain. So here's our basic accounting equation. It hasn't changed, guys. It's still the same. Assets on the left, liabilities and owner's equity on the right. And so we still have our source documents. Those have not changed. Our purchase orders, our sales journal, our, sales invoices, our regular checks, and all of our source documents have not changed. Our memorandums. We still have to have debits and credits. So that's our double entry accounting. And we're still going to be putting them into journals. And those are our special journals, those sales journals, those purchases journals, cash receipts, cash payments, and then their general journal. So we're still doing the same thing. We're still analyzing the transaction. We're still putting it into um I'm going to get me off here so you don't see my little ones behind me. We're still putting them into, those special journals. We're still, like I said, analyzing the transaction, journalizing it, posting it, still doing those same accounting steps that we've done forever. So,
Cam is on your computer?
yes. Okay, so here is, you guys know what the general journal looks like. There's our general journal. Here's all of our setup for our accounts. Remember, this is what you had when you first started accounting one eons ago, what you had on your 3x5 card that we created. And so you still have your ledgers. You still have the ledger, you still have your list of all your accounts. You still have your accounts payable subsidiary ledger. You still have your accounts receivable subsidiary ledger. None of that has changed. And so, like I said, this chapter is kind of like a review for all of those for a review for the beginning here. So we have our file maintenance. It's still the same. The only difference is now it's still going to tell us if it's a 1, whatever that number at the beginning is our asset liability owner's equity over here. So 1, 2, 3, 4, 5, 6 category is where it's at in that. So, is it the third thing in the assets, and then where it's at within that category. Oh, I left that in there for you. Free answer. Woo woo. Usually I take those out. I missed one. So now we have the departments. So the departments basically they're adding a few more. They're adding a few more accounts to us for that merchandising business. So here we go. Here's our purchases journal. Same thing. We still have here's our accounts payable credit. Notice the thing that's different here is under purchases. Now I've got 2 different types of accounts here. So I'm purchasing what? So over here on the invoice, it's going to tell me right here, I've got my date, I've got my document number, and then here it tells me what I'm purchasing. And I'm purchasing furniture. So this invoice is just furniture. So I've got my date, my manufacturing, who I'm buying from, my purchase invoice number, my accounts payable, and then I'm purchasing furniture. So if I was purchasing grills, I would write it here, but I'm for furniture, so I'm going to write it here. So that hasn't changed. It hasn't changed at all. And so we're still posting at the end. We're still posting, our individual accounts every week. And then we're still posting our totals of our columns here at the end of we're still posting our totals here at the end of every month. So remember, individuals, these guys, accounts credited, goes every week, gets posted. These totals here get posted at the end of the month. So this is just an easy way. They have it set up for you to double check your debits and credits to make sure that you match. So then that way you can double underline here. Okay. So we still have our debit memorandums. Those are our purchase returns and allowance. The only difference here is that notice at the end here, it has the word grills. So this is a return, and notice it's a grill cover. So it's going to come out of, when we purchase grills, it's going to come out of grills. It's going to be our purchase returns and allowance grills. So it comes out of the right purchases. So cash payments are still the same. We still have our same cash payments journal. The only difference, the purchase discount credit is now got a grill section and a furniture section. So if we're paying an invoice and it was a grills invoice and they gave us a discount, that discount's got to go under grills. If we had an invoice and it was a furniture invoice and they gave us a discount, we put the discount under furniture. So that hasn't changed. So this shows you how to take a discount after a return. So in this case, here's our original amount on our invoice. We returned $182 of it. So this is how much we owe after the return. And now we're going to take the discount off the amount that we owe after the return. So the 642, multiply that by the 0.02% or 0.02. It gives us $12.84. So this is the amount that would go in the accounts payable. This is the amount that would go in the purchases discount, and then this is the amount that's going to go into cash. So there it is. There's the transaction. Okay. These transactions, like I said, are not different than you have done before. The only difference is that it might have a department, it might come out of a specific department. So this is how, oops, so this is how here we would determine our cost of merchandise sold. So we take our inventory at the beginning of the year, we add, we have our purchases for the year. We have our discount and returns and allowance, so how much we've discounted and returned. And then these two would be subtracted, and that would give us our net purchases. Okay. So they have a different couple of methods. So we have what they call that gross price method. So it says some businesses elect to record the purchase discount when the purchase invoice is approved for payment. And then we have our what they call the net price method. And it says when the invoice is paid, the transaction debits cash and credits accounts payable for the net amount. So the account recorded is the net to accounts payable is the net of the invoice amount and the purchase discount. So this is, they've already taken the discount out or before the discount. The other one is they've taken the discount out. Oh, this thing is going crazy. I haven't touched it. All right. So here's an example of just a payment in the cash payments. So we're buying some inventory. We're buying some grills with cash. So in this case, it's going to go under general. Notice it says merchandise inventory grills. It's going to go under our general debit. And then we have our cash credit. So our normal buying supplies with cash is going into cash payments, rent, you know. And then, of course, we have our lovely replenishing our petty cash fund, which you guys have now done twice. Once in accounting one, once in accounting, and now in accounting two, the first semester, and now you're in accounting two, second semester, and here we go again. So it lists all of our items that we have purchased, and then, of course, how much that amount was. So, like I said, the biggest deal here are these adding these little sections of now we're paying for advertising for just our grills, and we'd have an advertising just for our furniture. So it's kind of breaking them up into different departments. So posting from our cash payments journal, normal. Individually, our account titles during the week, and then, of course, our totals at the end of the month. Notice we have our same 5 steps. Those 5 steps never change. You know, those 5 steps never, ever, ever change. So that is it. Like I said, it's kind of like a basic, real quick, um, just a review and kind of an introduction to those different departments. Have a great day, guys.